Hi everyone, this is Ted Bauman from Banyan Publishing. In my video this week, I review the performance of various asset classes during the year 2018. As we know, it was not a great year for the stock market, but plenty of other asset classes actually performed significantly worse than US stocks. And it's useful to know what those are, as well as knowing what particular sectors inside the US economy performed at various levels, because that might give you an opportunity to think about where value might be found in the year 2019. If things really went bad in 2018 for various asset classes and they're undervalued, they could be something to look at. I also look at the performance of various currencies because I think in 2019 it's quite likely that currencies will be something, a place where we could potentially see some earnings, probably not the kind of sky-high earnings that we've seen in the stock market during 2017, but certainly where one could earn solid returns. So let's have a look at the performance of asset classes during 2018.
All right, let's have a look at how assets performed in general in 2018. As you can see from this chart, the only asset class, or really the only asset that achieved positive returns for the year was the US dollar. Now, the US dollar, when we talk about it as an asset, really what we're talking about is the dollar's value versus other currencies. So holding on to dollars doesn't mean that you were 4.6% richer than you were at the beginning of the year. It simply means that you could buy that much more using dollars if you were buying things that were priced in foreign currencies. So in some ways, that's not really relevant to most of us. But it does reflect something important, which is the flow of money into the United States, partly because of interest rate rises, but also because of the strength of the stock market earlier in the year. Foreign investors were sending money into the United States, and when they do that, they have to buy dollars, and that pushes up the price of the dollar relative to other currencies. So that's why we see that green bar there. The only other asset class that returned a positive amount was U.S. bonds, but we expect that because bonds are essentially supposed to be, and here we mean treasury bonds, we mean government bonds, but bonds are supposed to be something that earns well. That's the whole point of them. They are a safe asset. They're guaranteed to return a certain amount. So it's neither here nor there. By contrast, corporate bonds actually provided a negative return during the year. And this is an interesting statistic because people often overlook the corporate bond market. Corporate bonds are basically when companies say, we want to borrow money to do something. Maybe we want to invest in a new factory, or maybe we just want to return some money to our shareholders, or maybe we want to acquire another company. And generally what happens is that when this debt is issued, it then gets traded just like it does, or like treasury bills do. People buy and sell bonds that are promises to repay from these companies. And when the value of these bonds falls, it means that essentially the interest rate that these companies are having to pay on their debt is rising. So that's not a good sign. It means that companies that borrowed expecting to pay a certain amount of interest are actually now having to pay more because of the decline in the price of corporate bonds. So that's something to be aware of. Gold was down 2.6% for the year. Again, not surprising. We've seen a rapid turnaround, though, since the beginning of the year. The S&P 500, our proxy for the stock market as a whole, as everyone knows, was down 6.2% for the year. U.S. real estate down. And here's an interesting issue, considering the fact that we have, we're said to have a shortage of housing in the United States. Why would real estate values be falling? Well, partly it's because interest rates have been rising, and as a result, prices have to fall to accommodate the fact that higher interest rates mean higher bond payments. Then Canadian stocks down 12%. U.S. small caps took a big hit this year. Again, they started to turn around now in January, but if you were invested in small caps, you would have lost more than twice the market's overall negative return. Commodities down by 14% almost. Foreign stocks, basically foreign developed country stocks down by 14.5%, and emerging market stocks down by 16.9%. Now, it was a bad year for equities. It was a bad year for commodities. It was a terrible year for crude oil. We've started to see a turnaround in some of these things at the beginning of this year, but there's no guarantee that it is going to be sustained. We're still waiting to see. Let's now look at the S&P 500 from a sector perspective. As you can see, there's only really two parts of the economy that produced positive returns during 2018 in the stock market. One was healthcare. That's a pretty good return, 4.7%. Utilities up a little bit, 0.5%. A lot of that gain in utilities actually happened in the fourth quarter because people tend to turn to utilities as safe haven stocks when the rest of the economy or rest of the stock market is turning down. So to a certain extent, what we're seeing there is the knock-on effect of declines in the rest of this graph, things like financials, industrials, communications, materials, and energy, of course, the big one, that being oil shale production and fracking companies and things that suffer when the oil price goes down. So realistically, the only sectors besides healthcare and utilities that didn't do as badly as the market as a whole, which was down 6.2% for 2018, were consumer discretionary, technology, and real estate. And remember, having stocks or assets that decline in value but not by as much as the rest of the market is a good thing. Not every asset that one holds can actually have a positive return, but having less of a drop than the rest of the market is also a win. And so I think it's important to look at one's portfolio going into 2019 and look, how is your portfolio distributed across all these asset classes? Which ones of these are likely to bounce back during 2019? An initial indication, I think, that utilities will continue to bounce back. Healthcare is continuing to earn positive returns in January so far. But the rest of them, it's hard to say. Consumer staples will probably bounce back. But really the rest of them depend on earnings, things like the industrial companies, materials companies, communication services. All of these will depend on earnings. Their bounce back will depend on changes in interest rates, and all of these things are unknown at this point. Now let's have a look at how currencies performed. I'm going to be writing a Bauman letter issue fairly soon on currencies, but as I mentioned earlier, the US dollar up by 4.6%, but the yen also up by 2.9% this year. In January, in fact, I recommended that one thing that you could do during the year was perhaps to invest in the yen because it's a good safe haven currency. Initially, because the economy or the stock market bounced back after that initial decline in the beginning of 2018, the yen didn't do as well as I thought it would, but it came back pretty strongly in the fourth quarter, and it's still doing well now. So the yen remains an interesting play. You can purchase the ETF FXY for exposure to the yen. And again, I'm going to be talking about that in an upcoming Bauman letter. As far as the rest of the currencies, not such a great show. The Swiss franc, that 0.6 is really just a reflection of the strength of the dollar. They're usually about on par. The euro, not down too much, but not the great performance. That reflects concerns about the European banking system, but more especially, it's down because the dollar is up. The rest of them, though, the won, the pound, the Canadian dollar, the Indian rupee, and the Australian dollar, downward pressure on those currencies reflects fundamental problems. In China, it's the slowing economy. In Britain, it's Brexit. In Canada, it is the massive exposure of the Canadian economy to shale oil. And the drop in demand for Canadian dollars as a result of the drop in the oil price. The Indian rupee, for a variety of reasons, the Indian economy is having a hard time getting going. And the Aussie dollar fell a lot because Australia is so exposed to the Chinese economy. So when, China sneezes, Australia catches a cold. And that's exactly what happened in 2018. Now let's look at a couple of other asset classes, some winners and losers. I'm going to start on the right side. Bitcoin, as I predicted at the beginning of 2018, had a terrible year. And at the end of the year, almost nobody was talking about Bitcoin as a big thing that people wanted to invest in. I said that was going to happen. I was told it was a weak call, a lazy play, etc., etc. I was right. They were wrong. I am not qualified to say what's going to happen to Bitcoin itself, but I think it's fairly certain that if you're going to make money in alternative cryptocurrencies, it's not going to be in the currencies themselves. It's going to be in the application of the technology, as my friend and colleague Ian King says. Goldman Sachs really was the big loser in the financial sector, partly because Goldman Sachs is trying to dial back its footprint in the United States economy, because being the biggest weed in the field often leads to having your head cut off. And I think Goldman has taken a strategic decision to try to moderate itself in order to try to, have not be so obvious as the powerhouse that it is in U.S. Finance and also in politics. But I think Goldman also suffered because of the general decline in the financial sector as a result of the increasing interest rate environment. And in terms of companies, Kraft Heinz and General Electric both had really bad years for different reasons. I'm not quite sure what hit Kraft Heinz, but we know that GE has just simply battled to restructure itself into a profitable company in the aftermath of years of kind of taking for granted that it was the biggest player on the block, making some disastrous investments that turned out to be disastrous in retrospect. Going over to the left at the bottom, Merck & Co. and AMD, the two big winners. And AMD, it's interesting. At the beginning of the year, everybody was hot on AMD. Then it had kind of a rocky patch in the middle of the year. But look at it now. It was up almost 80% for that year. And it just goes to show you just never know. And if you had bought and held AMD during that year, that would have been your big winning position. Last but not least, alternatives. Now, in the past, I have written about collectibles and alternative assets like stamps and things like this, fine wine, fine art. But one of the things that I've realized is that, number one, the assets that really appreciate in value in the collectible sector are the ones that have big price tags. They're out of the reach for most of us. So for most of us, the idea of trying to make money, or rather try to grow your wealth by investing in these things, is really not really feasible because of the price tag. The second issue is liquidity. And, as anybody who's bought stamps, for example, knows, it's great to see the paper value increase, but when you try to sell them, that can take a year or two to find a buyer. That's often the case with art and wine as well. So although those numbers look good, take them with a grain of salt. It's difficult to make money out of these things. However, they do have an important role to play for many of us as part of a larger portfolio, because they tend to go up constantly. They tend not to fall in price. In other words, they are non-correlated to the rest of the market. They just go up and up and up. Well, that's a survey of what happened in 2019. What's going to happen for the rest of this year is anyone's guess. As I speak, today I'm recording on Thursday the 10th. Chairman Powell is speaking, and I see the markets fluctuating practically on the basis of every question that he answers in the speech that he's giving at the moment. So we'll see. I think this is going to be a year that's determined by the actions of politicians and technocrats more than anything else, and that makes it inherently unpredictable. This is Ted Bauman, and I will see you again soon.
Well, there you have it. That's how things performed during 2018. And remember, these are issues that are constantly in flux. And one of the reasons for considering where things are coming from is because it gives you an idea of where they might go in the future. But there are no guarantees. So don't make a decision on what kind of assets to purchase, whether to invest in commodities or stocks or onshore or offshore stocks, without paying careful attention to what those of us here at Banyan have to say about the latest developments in asset markets. This is Ted Bauman from Banyan Hill, signing off. Bye-bye.